The Property Bulletin by London Property, the home of superprime.
New research shows that the UK's housing boom didn't just reward homeowners, it reshaped opportunity for their children. According to analysis from the Institute for Fiscal Studies, parents who benefited from rising house prices in the late 1990s and 2000s passed on a lasting advantage. For every £100,000 of extra housing wealth parents held, their children were around £15,000 better off in assets by their late 20s, and far more likely to access high-paying jobs. Location is the multiplier. Families with property gains were more able to help children move to London, where the highest-paid roles are concentrated. This mattered more than parents' education or profession. Children of renters, facing higher costs and fewer safety nets, were far less mobile. The gender gap is striking. The biggest earnings gains accrued to sons, who were disproportionately represented at the top of the pay distribution. The study found no comparable effect for daughters. All this sits against a worsening backdrop. The Resolution Foundation notes that UK housing now offers the poorest value for money in the developed world, while wages, especially for young people, have stagnated. Rents are rising sharply, ownership is slipping out of reach, and a quarter of under-30s say they may leave the country, according to the Adam Smith Institute. The takeaway, property wealth has quietly become one of the strongest drivers of inequality, shaping not just who owns homes, but who gets ahead at work. Many London homeowners assumed their flat would be a long-term store of value, even a pension. Increasingly, that assumption looks fragile. Despite the belief that London house prices always rise, the market has been stagnant for years and is now falling. In 2025, average London prices dropped around 2.4%, masking far steeper declines in prime areas. Kensington and Chelsea saw double-digit falls, and parts of London have seen prices drop close to 20%. London sellers are now more likely to crystallise losses than anywhere else in the UK. Several forces are converging. Changes to non-dom taxation have pushed internationally mobile wealth elsewhere, swelling supply in prime postcodes just as demand weakens. Proposed mansion taxes add further pressure. At the family end of the market, VAT on private school fees has hit already stretched households, prompting some to leave London altogether, bringing more suburban family homes to market as buyers retreat. Flats are under particular strain. Rising service charges, up over 10% last year, have turned many luxury developments into financial liabilities. On top of that, unresolved cladding and building safety issues continue to make thousands of flats hard to sell or mortgage. Buy-to-let has also lost its appeal. Higher capital gains tax and stronger tenant protections have reduced returns and flexibility, pushing many landlords to exit rather than reinvest. Overlay all of this with broader concerns, crime perceptions, demographic change, and the long-term impact of AI on London's service-led economy, and confidence is clearly fragile. Even London's Mayor, Sadiq Khan, has warned of potential mass job disruption from artificial intelligence across finance, law, and the creative industries. London has always reinvented itself, but this combination of policy shifts, structural costs, and economic uncertainty explains why some fear this downturn could feel very different from previous cycles. Britain treats pension saving and home ownership as separate goals, yet both serve the same purpose, long-term financial security. As home ownership declines and retirement costs rise, that divide is becoming a growing policy problem. Successive governments have focused heavily on improving retirement outcomes. Automatic enrolment has been a clear success, and further reforms are expected to raise minimum contributions over time. At the same time, policymakers worry about falling home ownership, especially among younger generations, yet most interventions, such as new ISA products for first-time buyers, address symptoms rather than root causes. The reality is stark. People who rent in retirement must either save hundreds of thousands more in pensions or work significantly longer, increasing pressure on both individuals and the state. That makes housing affordability not just a property issue, but a pensions issue too. Regulators are starting to acknowledge the link. The Financial Conduct Authority has proposed reforms to make mortgages more flexible, helping buyers use existing housing wealth later in life. But this still doesn't solve the hardest problem, building a deposit in the first place. Other countries offer clues. New Zealand's KiwiSaver allows first-time buyers to withdraw from their pension to purchase a home. Similar approaches exist in Singapore and South Africa, either through withdrawals or borrowing against pension assets. These models involve trade-offs. Early access can reduce retirement income, but they recognize housing and pensions as two sides of the same coin. As PIMFA argues, greater personal wealth ultimately reduces reliance on the state. If government wants sustainable pensions and higher home ownership, it may need to break down the silos and treat housing and retirement saving as part of a single financial system. prime rents rose fastest last year in southwest London, according to new research from Savills. Average prime rents increased 6.8% in Wandsworth, 6.3% in Putney, and 5.4% in Barnes, well ahead of prime central London, 0.9%, prime outer London, 2.4%, and prime regional markets, 0.9%. Outside the capital, growth was strongest in commuter belt locations such as Winchester, Farnham, and Henley, reflecting continued demand for space and connectivity. Savills says southwest London's outperformance is being driven by domestic needs-based moves. Strong transport links, good schools, and access to green spaces are commanding a clear lifestyle premium. At the same time, some rental stock has been lost to the sales market, keeping supply tight and rents competitive. Landlord sentiment, however, is more cautious. A Savills survey shows confidence has dipped following the November budget and the forthcoming Renters' Rights Act. While some landlords may reassess once the rules take effect, others are choosing to adapt, suggesting a period of adjustment rather than a sudden pullback in the prime lettings market. Office space has become the most in-demand commercial asset in England, according to new research from BPS London, as investors follow the accelerating return to workplace-based working. Nationally, 30.5% of office opportunities are already under offer or sold, subject to contract, the highest share of any sector. Retail is close behind, 30.2%, followed by industrial and warehouses, 27.5%. Leisure and hospitality lag at 16.1%. Regional strength is clear. Investor appetite for offices is strongest in the West Midlands, 39%, the South East, 36.6%, and the East of England, 33.1%, reflecting businesses re-embracing physical workplaces beyond the capital. London is the outlier. Only 21.6% of office opportunities in the capital have attracted interest, not due to weak occupier demand, but oversupply. Offices account for 71% of London's available commercial rental stock, intensifying competition, especially where buildings no longer meet modern expectations. Survey data commissioned by BPS London shows demand has returned decisively. 54% of London office workers are expected in full-time, with a further 36% predominantly office-based. What tenants want has shifted too. Better tech and meeting space, upgraded communal areas, improved air quality, thoughtful design, and on-site amenities now top the list. The bottom line, offices are back at the top of investors' shopping lists nationwide, but in London the winners will be well-designed, future-ready buildings that match higher occupier expectations.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.